Hello, my people. Welcome back to this YouTube channel. So, it's been a long time since I made another video, but today I have decided to make a short video on mitigation block. So, this is one of the institution reference point where they mitigate or execute their trades or closes their positions. Yeah. So what's a mitigation block? You're supposed to write this. Make sure that you have written this down on your notebook so that you can refer it later with time. So what's a mitigation block? It's an area where smart money or institutions return to mitigate. To mitigate means to open those positions. So to mitigate or close previous positions, they can also close or open some positions. So it usually happens after impulsive move where price come back to fill those orders that were left behind. Yeah, so that's the best or a short definition of mitigation block. So make sure that you have written that down. Yeah, it's more useful. You can recall it later. You can write it on your book. Please make sure that you have done that. So how it works. Institutions open large positions, often in an imbalanced areas. Imbalance, those are fair value gaps or three candlesticks formation where there's a gap that is formed in between those the first and the third candlestick. We are going to discuss about the imbalances in the market, also known as the fair value gaps. So I know most of the people who use smart money concept they have learned more about fair value gaps, the breakaway fair value gaps. Yeah, institution open large position often in an imbalanced area. Mhm. Price quickly move away, leaving some unfilled orders. Yeah, there are some unfilled orders there. Price retrace to mitigate those unfilled orders that were left. Mhm. These zones, these These zones becomes a mitigation block, often used as a continuation zones. Example, a price drop massive from a supply zone, it come back to partially fill the offense supply order. That areas act as a mitigation. That area act as a mitigation block where price moves. So I'm going to illustrate using a diagram. Then yeah, I'm going to show you on the re-chart. So a mitigation block it's something like this. We have bullish mitigation block and bearish mitigation block. A sweep of that liquidity, then market will drop massively. So as you can see, there's no sweep of liquidity above this previous high. There's no sweep of there's no sweep of liquidity above that. There's no sweep of liquidity there. So it creates this was a previous order block. This was previous order block. So the price was supposed to come and bounce back to it was supposed to come and bounce back here, then it buys. But the market did an opposite of that. The market broke that previous order block. This previous order block that was formed here. So when it breaks this previous order block, so the market will this will be a mitigation block. It changes from an order block to a mitigation block. So this is where there is there's selling opportunities occurs here, which is a trend continuation because there's a market structure shift here. There's a market structure shift. After market structure shift, you wait for a retracement. You wait you wait for a retracement into this mitigation block, then you place your sales position, your 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 stop loss above that high, then your take profit above this sales liquidity puts that reside below this holds lows that are here. Yeah, higher loss that are previous on this side, higher loss, yeah. So that's how this is like an example of bearish mitigation block. So I'm going to show you an example of bullish mitigation block. A bullish mitigation block is something like this. There's no sweep of liquidity, then the market broke that, it will retrace back, then it sells. That's an example of a this is an example of there's no sweep of liquidity here. I know you are confusing this with a breaker block. A breaker block, there's sweep of liquidity below this. A breaker block, but this is a mitigation block. There's no sweep of liquidity below this low. So after breaking this, the market forms what's called a mitigation block, which is a bullish mitigation block. The market will retrace back on this side, which is a uh, your stop loss below this. Yeah, those are examples of mitigation block. This is a bearish mitigation block and this is a bullish mitigation block. So let me show you on the real chart. On the real chart, let me draw. The market came here down, up, then it came to this, then sells more massively. So as you can see, this is an example of a mitigation block. The last, this is an example of a mitigation. As you can see, this zone is more respected. When the market touches there, it will sell massively. So that's an example of a mitigation block. This is a bearish mitigation block. So your stop loss, your stop loss below this or above that. This is a buy and this is a sells positions. Put sell. Sorry. I don't know what's happening. Yeah, your stop loss here and here, take profit below this. As you can see, your take profit was massively smashed. It was later massively smashed. Yeah, the market tested that order block, this mitigation block, but it later took these sell liquidity pools residing above this low, the recent lows. This is a sell side liquidity sweep. Yeah, that's an example of this is an example of mitigation block, which is a bearish mitigation block. Let me show you a bullish mitigation block. A bullish mitigation block can be the opposite of that. You can come here. Let me just invert this chart. Yeah. Says the market came here. It went up. After going up, it will retrace that. Then it will take some. Let me take this on that and this side so that I can show you it. The main thing in this unit is a matter of understanding what you have been taught. So this is a breaker block. Sorry, not a breaker block. This is a mitigation block. As you can see, this market respect that zone. you put your long positions. I don't know what's happening. Yeah, on the first point, yeah, then your take profit above this, then your stop loss below this. That's a risk to reward of 1 to 2, or you can target this above sell side liquidity pools there, these sell side liquidity pools, so that you can increase your risk to reward to 1 to 3. Yeah, which is 1 to 4. Your stop loss below this low, then your take profit on either any sell side liquidity pools that reside above your or your above your entry point. Yeah, then your stop loss below your entry point. So that's all that I can show you about a mitigation block, bullish mitigation block, and a bearish mitigation block. So thank you, and please make sure that you have subscribed, like, and share this video.